The goal of the summit is for each of you to challenge your perspective of volatility, hedging strategies, and options trading. We look forward to a full day of presentations and panel discussions, analyzing the current competitive landscape of volatility across global markets, and educating investors on the use of volatility strategies in institutional portfolios, all live from our very own Volatility Stadium.
At least for the next 10 years, we think the market is forever changed. And let me tell you why. The size of that Fed put is going to be significantly smaller. And that's a powerful change in market dynamics. That's a powerful change in market behavior that will affect everyone in this room. That central banks are never going to be as accommodative as what they were historically, because they've now seen the wrath of inflation. The strike price of intervention globally is significantly lower, and also the size is significantly smaller. So that just means the level of volatility that you're going to have to experience in your portfolios is going to be higher.
So I think what's notable when we see at the start of the year is, of course, as alluded to across various media, that we had a down move in the markets and we didn't see that much responsiveness in any volatility measures. And also, if you look at what happens to volatility on a per strike basis. What's interesting is that when you look at the configuration at the start of the year, skews were a bit more elevated relatively. And also when people note at what's dealer positioning, what do the market makers and these participants have, they were relatively short, which indicates that actually the other side of the trade, the end users of volatility, the hedgers, were relatively well positioned.
We think in terms of scenarios and probabilities. And we're really much process oriented. So what I like to do as a manager is really focus on liquidity and put myself in a situation where I'm never forced to exit a large position very quickly and find myself in a position where I cannot do that, right?
So that my view is that not only now we don't have a Fed put anymore, now we're short a call to the Fed, right? Because any easing of financial conditions, the Fed will match with more hawkish policies, right? And that will be there for a long while, right? And that puts a floor on vol. So vols should be higher, correlations should be positive, and I think that that's the world that we're going to be living in for a long while. And
the rates also are higher, so it means that you have more space to, let's say, offer structured product with higher coupons for clients. And we see that as interesting because within the context of this uncertainty, we see more and more people going for guaranteed or not guaranteed structured products, which will, in Europe, it always have a huge impact on volatility.
Stay liquid, don't lever and extend and kind of chase that marginal kind of tiny margin, if you will, with big financial gearing. So it's going back to some real blocking and tackling because we do have higher vol and higher rates, and that's more cash flow, right? That subsidizes a lot of risk.
Cost is one significantly important input into the process of hedging, but there are several other factors, risk profile of the portfolio, tolerance for basis risk, requirement for confidence around the payoff profile. All of these things are also significant when determining a hedging strategy for a hedge fund portfolio.
I think the hardest factor to hedge is against psychological risk, behavioral bias, career risk, peer risk. Those are really difficult because those are really intangible, and there's different things that drive the motives of various different stakeholders. And the only way to really get a good hedge around that is by education, by open and honest dialogue, and really understanding where clients are coming from and where colleagues are coming from and where our managers are coming from.
I think the fact that bonds have not played that defensive role this year, I don't think anyone was really surprised by it. We all knew it was a possibility, but it did drive more interest in diversifying strategies.
Obviously, our perspective is that central banks have been way too active in markets. I mean, that's part of the reason we've had distortions for the last 12 years, and I think that's why we're all in the position that we are today in terms of trying to figure out how to cope with a world where the central banks basically react in a much different way than they have for the last 12 years.
You have lack of willingness by banks to warehouse risk or decreased willingness by banks to warehouse risk. You have pretty healthy supply of issuance, and you have a whole subset of investors who won't touch the risk. So that could be frustrating maybe from a marketing standpoint, but from a portfolio management standpoint, it creates pretty good opportunity in the space.
It's a dual digital, and what we're really going after is to get protection in a risk-off environment. And so the trade itself is where we buy a dual digital on Eurostoxx 50, a digital put on the Eurostoxx 50, which is a dual with both the Eurostoxx 50 and the euro moving lower. And it's a one-year option.
We manage usually fairly diversified hedging solutions for clients, and within these solutions we do, broadly speaking, two things. One is we construct protective structures using equity or equity index structures, and another bucket is what we call indirect. We look across all asset classes and try to find something that should work in a crisis, but has, in our mind, better risk-return profile than usual equity options.
This year has been a year where convexity hasn't per se paid off. You all know it from the VIX. It hasn't been a huge payoff. And it has been a great year for trend and other systematic strategies because it's been a regime shift. So exposures have developed slowly, which is kind of what trend managers and systematic managers want to see. So as those exposures develop slowly, they've had windfall gains, in many different asset classes.
I polled various banks just to see what their opinions of where we are in that profile of how the hedging supply and demand for long-dated options looks. And everyone has their own answer. They all have their own books. But if you really kind of sum it up, somewhere between here and 10% down is the peak of where the Vega, the vol supply from all these structured products is.
And as much as your world you think isn't the same as my world, actually, there is definitely a joining of thought process in the fact that, I'm there and I'm thinking, right, just like you, manage the risk. Risk management, reduce the fear. Risk it, manage it, and then look at the decision you want to make. Make the decision of the thing that you see on your screen, that in this instance I saw at the second floor down. And so, we live in a world where you manage our risks and we try to reduce the risks, whether it's for millions of dollars or whether it's to save life or not get killed. When we talk about the Westgate Mall and the Dusit, that's spontaneous planning. That's what I see of a situation developing, and you adjust your plan and you make decisions and everything else. In these situations with Paul and Rachel and Judith and lots of others that I've done, it's a formed plan. It's the attention to detail. You think the process through. You absolutely try every war game you can think of scenarios that would happen. Distraction, vehicles, humans, aircraft, boats, everything, and put your plan together, but also have the ability that the plan will change. It will never last contact with the enemy. So you can put your plan together, but have options to adjust it.
Coming from the credit markets and always being aware of liquidity, I think tail events are not just about how sharp the sell-off is, but how hard it becomes to modify your portfolio, rotate through positions, or get liquidity and reposition for what you think is going to happen next. So it's as much about the drawdown in the portfolio as the ability to fulfill your job as a portfolio manager in a very fast-moving market that might not have liquidity.
We need to make convex returns to be able to go ahead and make enough profits to be able to take advantage of those downturns to be able to buy cheap assets. So tail risk focuses very much on convexity, but it has to focus on mispriced convexity to allow you to be able to maintain a low carry cost through a bull market to be able to maintain those convexities necessary to go ahead and to make those returns.
Interest rates move first and equities follow. And from a volatility perspective, what does that mean? Well, in the low inflation vol world, equity vol moves directly with equities and with high amplitude. But in the high inflation vol world, equity vol still moves, but the amplitude is much lower. And it's interest rate vol that really moves with the highest amplitude.
when we talk about the beta, we talk about the shift. But what the other factor that matters when you buy a forward-starting instrument is the roll. And because the term structures were very flat, the roll was actually quite beneficial. So in a way, yes, the beta wasn't as high as normal, but there was still some reactivity. And that basically has still been able to distinguish such strategies from simple put option purchase programs.
I would say was that inflation is an exponential function, it's not cyclical. We delude ourselves that it's cyclical and magically we're going to go down to 2% again or 3%. Yeah, I've lived through a hyperinflation and maybe that has biased my opinions, but I see inflation as an exponential function and it's going to be very difficult. It's like toothpaste. It's easy to get out and very difficult to get back in. And today's CPI numbers just probably another example of that.
You know, we can have conversations about inflation and rates and the Fed and this and that, but ultimately these are just conversations. It's impossible to predict not only the direction of certain things, but how they come together and then what's the market reaction. It's just not an exercise that we think we can do or anyone can do.
And right now we're really positioned on a more, getting ready for maybe a more bearish environment. So short equity, short bonds, long USD, long commodity. So we're actually looking now what could be some type of hedge now to hedge on the upside to make sure that we're kind of well balanced. But also it's always trying to be very properly sized.
So what's been coming down, some of it by design and some of it just by virtue of how the markets did, is that public equity bucket. Fixed income is going to come down. What will go up is some of the real assets that we've been working on, and some of that opportunistic. And by that I mean we're looking for all kinds of different sources of returns that are not driven by the same fact.
I definitely understand that there's going to be times when correlations spike, and we have to be ready for that in the portfolio. And I think the key to me is having a portfolio where you have a lot of different idiosyncratic drivers of return. So if you have some of the drivers of return in your portfolio all correlating at the same time, you still have other things in your portfolio that you can tap for liquidity so that you can take advantage of opportunities.
But I would just recognize today volatility is climbing in every field of human endeavor. It has to do with technology, has to do with a whole lot of things, but it's a world that right now is awash in change. That's how the former Secretary of State, George Shultz, put it, a world awash in change in technology, communications, obviously artificial intelligence, climate change, demographic shifts, huge demographic shifts, mass migration, effects of the pandemic, shifting military power, certainly shifting political balance of power. And what you look at when you look at history is you see change. Change was constant, but there is a difference today. And that difference is the speed of the change, the pace of the change.
So Trend has had just really strong performance over the past 2.5 years. What's really interesting is we've noticed that a lot of allocators, and certainly in the aggregate, they've actually been taking profit from Trend rather than sticking with it. And we have quite the opposite view. So, and the reason for that is we've been, so I guess one of the reasons that allocators have been taking profit is they've been kind of conditioned.
Still, I feel that within the commodity complex, you have like some commodities are driven by economic activity, economic growth, etc., which is a challenge at the moment, especially also with the lockdowns in China, etc. So there's a really very diversified palette within the commodity complex, and I think it matters very much of how you look at sort of the correlation structure in the market and whether you can use it in long volatility.
At the same time, I think that at this point the tails are starting to get underpriced. That people are now focused on this idiosyncratic risk. We're seeing it in flows. People are buying skew in single stocks and ignoring these downside tails to the equity market because of how things have performed this year.
The cost of power is going to be an exogenous shock to the system that we haven't seen before. It's out of the purview of central banks. If that spike that we've seen in power, 10 times up over the last year, moves from transient to something more structural, the impact on certainly European GDP, will require something like pandemic level bailouts. And I don't think anyone's really thinking that through fully.